Hi, my name is Christopher Terry, CEO of iMarkets Live, and in this video, we are going to speak on the introduction to the futures market. Now, with iMarkets Live, we have two types of futures that we work with. One is the S&P E-mini futures, and that's based around the S&P 500 cash index. The other futures are the Forex futures. So we're going to start looking at the S&P futures. You see here a chart. This is an hourly chart, which means 60 minutes of the S&P E-mini futures. What the futures are, they are a derivative of the actual index. Now, let me just move over. Okay. The index has been around since the 1950s, and the futures have been around since the 80s. The futures are a tradable instrument, basically, as I said, a derivative where you put up a small fraction of the value of the contract to trade it. If we look at the index itself, the price is $2,040. All right, that's the current value. Typically, it's multiplied by the E-mini contract, which is $50 per point. The big contract is $250, but most traders look at the small contract. So the value of this whole contract on a mini level is $100,000. We're able to trade this for a fraction of that. Now, what is the S&P 500 index? Well, it's made up of many, many stocks, as you see here in the middle of the screen. 500 of the leading stocks in the entire stock market, full of thousands. So we have 500 of them that we trade. Now we also trade the Russell index. And I'm going to change this right here. And this is the Russell index. We also trade this. This is a future, and the Russell index is considered the small cap index or the broader index. The small caps are the smaller capitalized stocks. That's all it means. And it's an index, and we also trade this also. So this value is 1170 at the time of this taping, and it's multiplied by 100 to get the value of the full contract. So you're looking at $110,000 in value, and we trade it for a fraction. Let's go back to the S&P futures. Okay. Now, what is great thing about the S&P is, as I said, we have all these stocks, and it makes up a multi-trillion-dollar market cap. So you're working at something that is massive, massive, massive. All right, so let's go down to a smaller time frame. Let's say a 5-minute chart. And this also operates 24 hours a day. Now during the day session hours, which are 9:30 to 4 p.m. Eastern Time, 9:30 a.m. to 4 p.m. Eastern Time, that's when the market has its most volatility. That's when it's mostly active. During the nighttime hours, as you can see here, it's more of a quieter market. It's unlike the Forex, because the Forex trades 24 hours a day, but they have different opens. They have an open in New York, in London, in Tokyo, in Sydney. The S&P E-mini futures are based on one exchange that doesn't go around the world like the other markets. And as I said, most action is during the course of a trading day. It's a volatile market. It's affordable to most people to trade it, and it's a very highly favored market for people to get involved with. Now we're going to look at the other side of the equation. We're going to look at Forex futures. Now I want to do a little comparison here first. Let's take a 60-minute chart. Okay. All right, we take a 60-minute chart of the futures, and it's basically similar to the Forex market. So if we look at the Forex market, the spot market is what we had discussed in our prior video. Here is the EUR/USD. So if I click on it, you can see it's going to change. Okay. So we changed this to the spot market that we had looked at in our prior video. And then we're going to look at this in the Forex futures market. So let's take a look at this and the Forex futures market. The difference between the spot market, which is the EUR/USD, that's 24 hours a day, and it never changes the symbol. In the futures market, the symbols change. You can see it right here, 6E in the NinjaTrader platform. And you can see it's exactly identical. So you actually can trade the futures market versus the spot market. The difference is, and we're going to explain this in another video, the difference between the Forex and the futures is you can trade the much bigger contract in the spot market for a lot less money in the futures market. So there's a lot of advantages and disadvantages for either market, but just wanted to recap. The futures are a derivative of the underlying asset. The asset, for instance, right here, let's just take the euro. Remember, we explained in our prior video, this is 1,000 times the value. So you're looking at 50 times the value in the US, and in the spot market, in the futures market, it's almost 200 times. So if you go into change your cash into a euro, the US dollar, you take your $1,000 and you're going to convert it into euro. You would buy €1 at $1.23 per euro, or spend 1,200 bucks. In this particular case, this is the big contract, so you'll be leveraging on $100,000 or 100,000 units. Well, if you're buying 100,000 units of the Forex market, it's $1.24, roughly $1.2350. So it would cost you $124,000 to trade this. But because of the leverage that's provided in the spot market and also in the futures market, the margin is only $500 to $1,000 to control $124,000. It's absolutely amazing. Now, if we look at the S&P E-mini futures, again, as we discussed before, it's 2,000 is the price roughly times $50, which makes it roughly $100,000 of the index, and the margin is only $500. So literally, you're getting hundreds of percent, 100 times leverage on your money. So looking at this is a highly leveraged market, and for a fraction of the money, you're able to leverage the entire asset. So imagine being able to control all of these stocks at one time for a margin of $500. It's amazing. So think about it, the futures, it's an amazing product. It's something I suggest, and I've been trading since 1995 successfully, and I've helped people around the globe trade this. It's an exciting market, and it's one of the products in our signal service, as is the Forex spot, as is the Forex futures, and the S&P E-mini futures. Hope you enjoyed the video, and we'll see you on the next video, margin and leverage.